on propelling agri-SMEs from early to growth stage investment. As a network of institutions that span the whole ecosystem of agri-SME finance, that as SAFIN we have found over the years that this is a recurrent problem or challenge for many types of actors, both on the supply and on the demand side of finance. So we're really excited to have this opportunity to have this collaboration today and to talk about some concrete solutions to the challenge. This will probably not be the last conversation on this topic, but we're really looking forward to setting sort of the right tone for the follow-up today. I will be introducing the speakers and the agenda in a few seconds, but just some housekeeping before we get there. Please make sure that your microphones are off when you're not speaking. Use the chat throughout the event to pose comments or questions. We will take note of them and they will be woven into the panel. So we will be engaging them as they come. Your suggestions, particularly your references to good examples of how connecting early and later stage capital in the investment cycle for agri-SMEs, where you've seen this working well, would also be really welcome. So we will also take note of that. So we will start with a presentation from Rachel Keeler, the Value Hub Director of AVPA, who leads the Value Hub of the Alliance, driving service delivery for the various stakeholders in the network. She will be presenting the new AVPA Deal Share platform that she designed and launched last year, and which represents a community that allows social investors to share funding opportunities with each other. So we're really excited to hear about the platform, and I'm sure that you will find it of great interest and of practical value for your work. After this presentation, we will have a panel moderated by Songbei Lee, who I'm happy to say is an active partner in the SAFIN network, and he is also the agricultural finance team lead at the USAID Bureau for Resilience and Food Security. Songbei joined the team at USAID last year in this capacity, supporting USAID in its efforts to mobilize private capital for agriculture. And before that, he spent a number of years at Calvert Impact Capital, a nonprofit impact investment debt fund. So he will bring that particular experience as well to the moderator. The panel is composed of Digi Adibusoye, who is a principal at Sahel Capital Agribusiness Managers, which is a private equity firm focusing on food and agriculture and investing in mid-sized agribusinesses. Then we will have Edward Isingoma Matsiko, who is a managing partner at Pearl Capital Partners Ltd, where as a team lead, among other things, is actively involved in the ongoing deployment of the fourth agri-focused fund of PCP, as well as the only Uganda focus fund, the Yield Uganda Investment Fund. We then have Hans Berg, also an active SAFIN partner, Regional Director for Africa and Global Agricultural Sector Specialist at Oiko Credit, which he joined in January 2018. As a Regional Director for Africa, Hans is responsible for the development and implementation of the entire strategy for the continent of Oiko Credit. Finally, we have Mercy Mutua, who is the head of investment advisory services at the African Enterprise Challenge Fund, AECF. Mercy is an accomplished financial specialist with over 15 years experience in a number of organizations and started her career in the banking industry as relationship manager for corporate finance and banking at the Commercial Bank of Africa in Kenya. So with this, I will hand over to you, Rachel, to start with the presentation, and then for you to hand over to Songbei and the panelists. Thank you.
Thank you very much, Bettina. Welcome, everyone. Thank you for joining us today. As Bettina said, we are here to discuss this handoff between early and growth stage funders for SMEs, which is really a core topic for AVPA. And if you don't know us, we are the African Venture Philanthropy Alliance. We're a network of social investors across the continent. And by social investors, we mean all different types of diverse investors that are deploying capital for social impact: foundations, corporates, donors, governments, angel investors, private equity and venture capital fund managers. We work across the board with all these different types of investors. And we try to foster learning and collaboration amongst them so that we can serve the entire, what we call continuum of capital, from grants, debt, and equity, all the way across to including non-financial capital, so that we can see more coordination amongst people who are working towards similar goals, but deploying capital in different ways. We're part of a global network, so we have sister organizations in Europe, Asia, and Latin America that help us to connect investors from around the world who are targeting deployment of capital in Africa or have lessons to share across regions. So last year, as Bettina said, we launched the DealShare platform, which is a community that allows these different investors, philanthropists, impact investors, and others to share vetted deals amongst each other. And the idea is that you see all these different types of and stages of capital in the market, investors deploying grants, equity, patient capital, blended finance, debt, technical assistance at early stage, later stage. And we want to see more coordination amongst them so that they can hand off deals between themselves, so that they can find co-investors to fill out their funding rounds, strategic partners, and ultimately exits as their implementing partners and companies move along this growth stages. And so today, we're really going to be discussing a challenge that is core to the DealShare platform, which is that many of you seen this graphic before, the funding cycle for startups, and it's been adapted here, I think, by VC for Africa for the African startup. That shows all these different types of capital that a company has to kind of go through before they can reach a sustainable scale. And we've heard from a lot of companies as well as investors that this can be very challenging, trying to understand how to source these different types of capital, to understand what the requirements are of these very different types of investors. Over the last many years, we've seen a lot of different donors and foundations come more strongly into the early stage funding cycle to try to catalyze innovative entrepreneurs and high impact SMEs by providing them early stage funding. But then, of course, what we're looking at today is kind of this green bubble in the center, which is what happens after that early stage capital comes in from grants and innovation funds and competitions and challenges and tech hubs and all of these types of investors. Why are we not seeing more companies graduate from that early stage into what you see there for the later stage, into more commercial capital, scaling capital from banks and private equity providers, and then also, angel investors kind of working across all of this. So the DealShare platform really tries to answer this question of how might we improve coordination amongst the diverse investors that we see here. And there are many more who are operating in markets across the continent, to really smooth transitions along this cycle. So we're excited to have the panel here today to discuss this very important question. We would love to see more investors join our DealShare platform, to share deals that you have in your network with each other, to find partners who you may not have found otherwise, to help your portfolio companies grow. And we're excited to be talking with everyone about that today. So enough from me. I am going to turn it over to our very capable panel today, led by Songbei, and we look forward to the discussion. Thank you so much, everyone.
Thanks a lot, Rachel, for that great presentation and kind of framing the discussion we're about to have. And I appreciate it. It was very, very to the point and not long. So I'll try to not talk too much as well and give as much time to our panelists as possible. I do want to encourage people as we have this discussion to ask questions in the chat box. And also this is, meant to be more interactive, informal. We do not have presentations. And I actually encourage the panelists to ask questions on themselves when there's something that they'd like to understand better from the other panelists. So the one thing I'll just kind of highlight is, so what Rachel was talking about, the continuum of social capital. So this is, broadly a question not just for agriculture, but here today we're focusing on the agricultural sector as our area of interest and as examples to kind of address this question. So I'm going to jump right in, and I think the first person I'll talk to is or ask a question is Hans from Oiko Credit, and if you could describe your organization and where it sits in the financial value chain, and if possible, I think it might be helpful to use a deal to kind of describe a deal that Oiko Credit has done, the type of investors who might have come in earlier, the type of investors who might be co-investors, the type of investors who might come later. And if you could also clarify in the beginning, because I think you're the one of the folks on this call that doesn't do just agriculture. So if you could kind of explain how agriculture fits in your overall portfolio as well.
Yeah, thanks, Songwei. And maybe we should have prepared this call, but let me give it a try. So talking about my own organization is, of course, simple enough. So Oiko Credit is a social impact investor. We exist since 1975. It's good to actually say, indeed, we have a portfolio of around 1.3 billion euros, and most of it is actually in financial inclusion. So it's around 80%. And the continuum of different types of capital, and also, let's say, the development stages which companies go through, and where does Oiko Credit sit? And when I first joined this school, I thought actually we are a real risk taker, and we are in, I would say, very high risk investments. But if I look at actually the stage before where we started invest, that's where the real high risk is. So Oiko Credit typically invests in companies who do have maybe indeed you would qualify them as established later stage companies who at least should have a significant track record, 3 years of audited financial accounts. And I would say we also looking at companies in the sense of they need to have, or we need to be able to do a certain kind of ticket size. On the debt side or at the equity side, we need to have at least a kind of significant stake. And if I relate that to kind of the ticket size, we are looking at, let's say, on average around between 1 and 2 million euros. So it starts at 500K at our end, we go up to around 10 million euros. So we are always interested to see how we can kind of work together with other organizations and to develop and pick up a pipeline of companies in the agriculture sector. It hasn't been always very easy, so to kind of to get the right match. So it's it's at times there are a lot of different programs around which kind of help organizations to mature and to kind of bring it to the pipeline of impact investors. And in all honesty, over the last let's say 2018, when I started at Oiko Credit, I had many of those discussions. I've seen many different websites, and my colleagues are here on the call, so maybe they can prove me wrong. But I haven't seen any deals coming actually from those programs which we're financing now. So in that sense, Rachel, I should actually congratulate you with this call, because it's a real kind of issue for us as well. So we try to kind of collaborate with NGOs, with platforms, with other types of financiers, but it hasn't been easy so far. Not sure if it's ever going to be.
Thank you, Hans. And so one thing, it's interesting because the question of getting from growth, from early to growth, back in my old job at Calvert, we tried to find a borrower and grow with them over time. And so Oiko Credit, I used to cover them at Calvert, and that's what we did. I think probably 10 years ago, our first loan, or maybe even 20 years ago, was probably a couple $100,000, and that just grew over time to $6 million at its highest level. So we never looked at trying to find someone to pass it off to. We would try to keep that as long as possible. But the one thing I know from being familiar with Oiko Credit is even among your peers who you would think are at the same level along this continuum, Oiko Credit is distinct. And I'd say, even though you might not take as much risk as an earlier stage investor, you do take more risk, in my opinion, than other investors. And I think that comes from your investor base. So right now, a lot of the discussion is kind of like who is in the system. But I think we can also, another level we should look at, besides the fund level, is the investors behind those funds, because that determines a lot of where they can play. So I was wondering if you have a unique investor base, and if you could describe how it's different than other similar funds and why it allows you to do something different.
Yeah, so we are indeed a cooperative. We have 600 members, and of those 600 members, there are a number of what we call info partners. So they are actually in contact with our investor base, and that are around 65,000 investors, and they have, via these members, they have a stake in the cooperative. And so, I would say actually most of those members, I was speaking to a number of them at our AGM this week, they're really interested in the social return. And so we have been, let's say, giving a dividend of around 1 to 2% since 1975. Last 2 years haven't been great for the cooperative. So we had to actually say we're not going to pay any dividends. And that's the return people get, a dividend return. I think actually that's almost applauded. So people actually say, that's great because you're doing the right thing. You're putting the money where it needs to be put at work, and you're taking the risk we want you to take. So it's in that sense, I think it's a unique investor base. And even during COVID time, actually, we saw additional money coming in. So investors who are actually entrusting us with more funds. As you say, it's a unique position to be at.
Yeah, I just think, just to really emphasize, this is equity. So their funding is flexible. It's not debt. And they can change the rate. They went from 2%, which was already low, to 1 to 0%. And they're able to do that because their investors are socially minded. And this is a theme I'll probably bring back up later in the conversation. Thanks, Hans. I'm going to go now to Deji at Sahel. So, maybe you can do a quick, similar introduction of your organization. And also, when we talk about early to growth stage, there's a lot of different ways we can think about that. And I was wondering how you think about that.
Yeah, thanks. And hello, everyone. So I work with Sahel Capital. Sahel is we're a private equity firm. We are based out of Lagos in Nigeria, and we manage a fund called the Fund for Agricultural Finance in Nigeria. It's a $66 million fund, and the target is it's a growth capital. And as the name suggests, the idea is we try to unlock growth in business models that are proven. So similar to something Anne said, what we look at is we look at businesses that have a proven business model. It's not early stage. There's demonstrable performance. They have the audited financials, and there's a clear case of growth. And basically what we want to do is we want to partner with them to unlock that growth. And that could mean many things. It could mean we want to help them scale into a new environment or a new geography, or we want to help them. It could even be acquisition finance. It could be helping them to launch a new product into the market, or unlock new capacity so that they can meet the demands in the market. So in that framework, we typically would not go very early to startups that don't have that model proven yet. So if I'll answer that question, where we stand in that entire chain, it is us looking at all those companies that have that model that they can show, and then they are looking to move to the next level where they don't have the right type of finance to support them, and that could be for many reasons. One of which could be the typical finance in the market just does not sit right with the type of risk or the type of structure that these companies have, and they would want something a bit more innovative or a bit more structured that will help them and take care of the different volatility in their requirement, volatility in crop cycles, or you need something that can cater to that, and that is where we come in to provide that financing.
Thank you, Deji. And so one point I want to make is the example he's giving is earlier stage equity, venture capital, maybe later stage private equity with more established firms. But we're also talking, like Rachel was kind of referring to, we're talking about going from grants to commercial capital. That's another gap where it could be from equity to debt. So we're not talking about any specific gap, but just this continuum of capital as organizations grow over time. And so I'm going to pass it on now to Edward from Pearl. And again, I think it's interesting because there's similarities between Pearl and Sahel. And if you could talk about those and then also how you're different.
Good. Thanks, Lee. Yes. A lot of similarities with Sahel, and yes, we do focus on growth, on providing growth capital to agribusinesses, SMEs in East Africa. At the moment, our key focus is deploying our Yield Uganda Investment Fund, where we are looking at both very early stage projects in agribusinesses in Uganda and growth stage businesses in Uganda. What we tend to do is, if we're going to look at very early stage projects, we really look at three key factors. One is innovation. The business model, the concept, what they're doing has got to be very unique. And recently we've done projects like in liquid egg processing, in moringa production and for export with a farm out grower model and things like that. So, but then we also look at the second key factor being impact, the social impact and involvement with smallholders is a key factor. If that box is ticked, then we are attracted to even very early stage startup businesses, venture type of structures that we deploy capital in. And then the third thing that is always very critical is that we believe the management teams, the people we invest in, are the key factors, and therefore it is a key factor in how we decide whether we are going to go in for an early stage rather than a growth stage. Growing with the businesses, with the Agri-SMEs, is a key factor, but we believe that because we only invest in capital somewhere between $250,000 to $3 million, we think that's the niche we need to be in. And therefore, we are sure people like Hans or Oiko Credit will be able to come in a little bit later stage and growth. And therefore, by that time, we've done some de-risking, we've set up systems, we've done processes, we have prepared the businesses to get to that level of capital absorption. But then also, we believe there are other players in the market that do the very smaller ones, $100,000, $200,000 type of projects. And we don't tend to play in that space. Yeah.
Great, thank you. And so one of the questions that's come in is the minimum ticket size, which Oiko and Pearl have mentioned. And I think, and Deji, did you mention your transaction sizes that you target?
No, typically we do between $2 million to $8 million.
Okay, and I do find that to be, there's a lot of times you try to define the size of the company, and one maybe oversimplified default is just the transaction size that they can absorb. And I know ISF Advisors recently has come out with an SME taxonomy that also kind of uses that as one of the reference points in addition to other criteria like revenue, which is usually more difficult to find out, and number of employees. So going back to the investor question, can you talk a little bit about your investor base? And I think because the reason I'm focusing on this, I think this is a more sophisticated audience listening in on this call, and to get a little bit deeper and to see how that determines the risk appetite that the fund can take and the return targets that they also determine. And for you, Edward, on Pearl.
I missed you a little bit there.
Yeah, can you talk about who your investors are in Yield Uganda, and how that relates to the target returns you're looking for and the amount of the risk you're able to take with these earlier stage investors, earlier stage companies?
Yeah, our investor base in the Yield Fund are mostly foundations and development partners. We have the European Union, we have IFAD, we have NSSF, the local pension fund, which was a very interesting mix coming in. We have Open Society Foundations and Finnish Church Aid. So these are all very heavy on social impact and alignment and interest on smallholder farmer support. So in each of the cases, that does drive and impact how the fund performance and return expectations are. Yes, we do expect a double-digit return financially overall, but we are also very heavy on social impact and as well very heavy on BDS when the SMEs are working with smallholder farmers. Yeah.
Got it. And so Daisy, can you kind of compare your funders so on the investment strategy, you're in a similar space, but what would your investors, how are they similar or different than Edwards, and how would that how is that related to the nuances, the differences between your investment strategy?
Yeah, so the spectrum of our investors includes a mix of impact-minded investors as well as commercially minded investors. So we have a blend of that. So we like to think about FAFIN being a commercial fund with an impact mindset, which is why our risk profile is probably different from that of Pearl's Capital. So we have a mix of DFIs like CDC, in the mix. We have KFW, we have the DGGF in the mix. That we also have locally, we have the Federal Ministry of Agriculture, and in Nigeria, we have our local sovereign wealth fund as well, and then the African Development Bank. So of course, that plays out also in the like I mentioned, in the risk appetite for the firm.
Yeah, so I think it's interesting that you have retail investors willing to take a 0% return for Oiko Credit. I think on the other end of the spectrum, it's interesting that DFIs, which don't exist for Pearl, might require less risk and higher returns, which might sound, which you might not have assumed at first, because Sahel is focusing more on growth stage, whereas Pearl is doing both early stage and growth stage. So now I just want to pass it on now to Mercy at AECF. And again, if you could just kind of describe where you see you fit in the ecosystem, but I think it's more challenging because I know just from our brief conversations before, you might come in at different points. And then also maybe to put you on the spot, if you're familiar with one transaction that I looked up is the Western Seed Company. If you could talk about that specific example, I think it might be interesting.
Great, thank you so much, Songbe. And really for ACF, primarily we do fit really at the earlier stage because our primary focus is to provide grants to catalyze these early stage companies. But then what happens, we stay with them for at least 5+ years, depending on the nature of and the design of the program. And within that period, then they do grow, they do mature. Some of them become growth stage companies, some mature to later stage companies. So you find then we end up fitting, as we build the portfolio, we fit in the entire spectrum. So we do have a pipeline for you, Oiko, we have a pipeline for you, Edward at Pearl, and we have a pipeline for Sahel. So I think it's just the conversations that are lacking. And in addition to providing this catalytic funding, we do also always, in most cases, I would say, provide technical assistance or BDS services to our investees. So we're able to, prepare these companies to become hopefully investor ready, but we're not seeing a lot of them attracting funding as we would have hoped. So, we just need to understand what can we do different or better that's relevant and speaks to, the investors out there so that they can be able to attract capital. Now, you did talk about Western Seed Company. I joined AECF about a year and a half ago, so I'm not very familiar with the company, but definitely it's in the ag sector, and I did come across it in my other life. But it did pass through, AECF. We did get the seed funding from AECF, and you can see Western Seed then has grown to be able to attract funding from other maturer investors. So we're able to catalyze this and de-risk these investments. And it's a question of having those conversations with investors as to how we can better do it so that by the time, they're exiting our program or, towards the late till end of the program, they're ready to absorb the money that's out there.
Thanks, Marcel. Lee, if I may just add, I must say during the time Western Seed accessed some seed grant capital from AECF, we were investors in Western Seed from our first fund. And then we went on to invest the second round capital. It's that type of business where we've had 4 private equity and foundation businesses investing at different times, but coming together as co-investors. It's one investment where we had a co-investment agreement that involved ASI Fund, the seed fund that we managed, Archman Fund, and Voxtra at the same time, just post AECF support to cross the hurdles that they had pre-investment for that round of capital. Yes.
Hey, and
Thank you, Edward. And that was yeah, go ahead.
Sorry. Yeah, if you allow me, because you said there, Oiko Credit investors don't expect any return. They would definitely love us to make a 1 or 2% dividend on their shares. What I said is that they're so committed to the company and to the cause that they're not withdrawing. Actually, they're actually providing us with more funding if we can't pay the dividend. But of course, our goal is also to make a financial return. However, they find social return more important.
Yeah,
Absolutely.
sorry, Lee. If I just wanted to comment on something Edward and Mercy said, that something they described something that actually answers the question you were referring to in terms of the work that AVPA did early on, and then Pearl Capital was able to take it on. There was that handshake between both. And one thing that I see happening, especially when you think of fund-to-fund handshake, is also what comes up is a question of valuation, right? The reality is that a lot of companies, a lot of firms, especially the financial funds like us, we would like to exit to a strategic investor because the exit then looks a lot more interesting than to a financial investor. But if you have another financial investor, there is that question and discussion around how do we make sure that the valuation works, for both parties. But then when you have groups like AVPA that are working with the smaller entities who will not easily find strategic investors, then it makes it easy because the kind of funding that they are receiving to help prepare them for investment is really not that type of investment that is looking for commercial returns. It's more a grant, helping them to get ready for those kind of investments, and then it makes it easier for financial investors to come on board.
Great. No, thanks for pointing that out, Deji. And I do want to follow back. Let me see if I can remember it all. First, Hans, yes, thank you for clarifying. That's what I meant. And sorry if it came out otherwise. They definitely do want a return, but they do care more about the social return than the financial return. And also, Edward, about Pearl, I think the reason I brought up Western Seed is that very fact that Pearl was in Western Seed before AECF came in to support them. And so, when I first started thinking about this panel, I tried to categorize you along this spectrum. And I think this example shows that it's not linear, right? There are maybe areas that you sit generally, but these companies can, go forward and go not backwards, but they can move along the spectrum in both directions as they grow.
Yeah. Totally agree.
So Mercy,
yeah.
And Mercy, I think I'm not sure if I missed it.
Go ahead. Go ahead.
Go ahead.
No,
I was just going to ask. I don't know if I missed it.
we say linear, that's so stage companies within our portfolio, depending on the nature of the program that we're running. So any investor can integrate and invest in our investees at any stage, because the portfolio is huge and it's a wide portfolio. So what I would encourage investors really is, the minute we run a program, is not to wait for the 2-3 years to see where they can plug in, because that's the mentality that we're giving grants, so it must be very early stage companies, is to come in and have a conversation with us and see what's the nature of the program, how does it fit into your criteria, whatever it is, and then start engaging with these investees and mine from that, program. And we work together in terms of the business development, the capacity building, because we do have the funding for that. And so you sort of start the investment journey a year or two earlier than you would have. And you could also maybe get an exclusivity to this portfolio of companies and then dip in and pick the best, as opposed to waiting at the end of the tunnel to see what churns out. You could start the journey much earlier And that addresses the issue of valuation. Somebody did bring up the issue of valuation. When you come in much earlier, 2 to 3 years, you're definitely going to get your investment at a better value, because then you're going to walk a journey of 2 or 3 years that another investor has not walked. So the question is whether investors are willing to do that, step back a year or two before, we help them do some of the.
Great, thank you. And Mercy, I'm not sure if I missed it. Did you explain the product you actually offer and the size that you, the typical average size or range?
Yes, typically we give grants, but our investees come to us for grants, but they have access to equity, debt, and all other manners of instruments. So they don't come to us for grants solely just because they're early stage or startups. It's just to help de-risk whatever products or need that they're addressing, because we're driven by innovation and such like elements that drive the program that we are running. So I think the message is that ACF, yes, as much as we provide the grant instrument, the investees that we invest in are not necessarily those that only require grant instrument. They do end up having a very blended form of capital from the beginning, and hence that's why it's an attractive place to come and mine for investments. Because you find all sorts of investments depending on the program we're running. For instance, if we run the RBF program, yes, we are providing grants to these companies because it's a RBF program, this is a revenue share program. You find that we're working with very growth to later stage companies that will be very attractive to the likes of Oiko. But maybe the messaging is not very clear out there in terms of what it is that we're offering.
And what's the size, the range of the grants that you give?
Between 100 and $1 million, but the average would be about 600.
Okay, thank you. And Edward, I think you came off mute. Did you have something to add?
Yeah, no, I was just going to say that just to demystify what Marcia just said by confirming that we've had investments with co-investors who are grant makers, and it has worked. Whether it's AB Trust or UNCDF, we've worked with them on same co-investments with our projects, and I think it's an exciting mix, especially when a grant maker is able to sit down with a PE player like myself and look at the investment need and decide which are these items that need to be funded by grant, which are these items that need BDS and technical assistance support, and which are these items that need private equity capital, say for CapEx growth and working capital and things like that. Yeah.
That's super interesting, Edward. So you're talking about you would do a co-investment now with another private equity fund, but with a grant funder who would put in grant money alongside your equity investment, but for different purposes.
Correct. And to put it in context, the real example is we've invested in a company called Chemical Laboratories in Uganda, where we've done a co-investment with AB Trust, and we've done a long-term debt investment, and they have done a grant support for the knowledge transfer and technical capacity building. Yeah.
Got it. Great. So now we've spent some time kind of talking about the subject in general, and I think we want to get to what Bettina's hoping is trying to come up with actually ideas of answers of how. It's funny, but this discussion makes it sound like there is maybe more happening than we realize. But I want to go back to a point that Mercy was talking about conversations. Maybe the conversations are just not happening. So I don't know if you want to talk a little bit more about that. I remember when I was at Calvert, that's one of the things I would do the most of is talk to other investors. That's how I would find my pipeline, but it would be similar investors. And I try to, that I could lend to their existing portfolio because it's already, that's going to be a known quantity. But maybe you can talk about what you mean. What kind of conversations do we need more of? And that was you, Mercy.
Really, speaking from the ACS perspective, is the conversations and maybe the perspective that people have of ACF is as much as we deploy grants, our investees require blended financing. So that's the kind of conversations we want to have with investors out there. We are going to de-risk these investments for you, and who wouldn't want that? So when I joined ACF, I was hoping investors would be knocking down the door, asking for a portfolio and wanting exclusivity to, part of our portfolio, but it's surprising that's not happening. And I'll be curious as to why, Oiko, Sahel, and Edward, you're not doing that, because then we could be able to sit down and have that discussion Edward talked about, and find out which role do we play as ACF and what role do you play as the commercial investors, and then how do we walk this journey with you? And we take the heavier lifts because we are offering technical assistance, and again, who wouldn't want that? So we're de-risking quite a bit. So I think it's just the messaging has maybe not been very clear, and it would be interesting to know, Rachel, how we can position ourselves better and let people know exactly the value we bring to the table. And then I want to see those doors being knocked down. That would be very exciting.
If I
great
can
question. So go ahead, Rachel.
I was just going to interject with a timely question that came through the chat from Tom Adlam at Pearl Capital, saying that a lot of investors feel like grants from providers like ACF are crowding out their investment capital. And I think that's really key to what Mercy was just talking about, is how can grantors work together with investors as opposed to crowding them out?
Yeah. We need to complement each other rather than being in a situation where you find a PE player worrying about a grant being around the impact on valuation and things like that. Yeah.
And I would say, this conversation already, Bettina, Safin, Rachel, for setting up this conversation, already is making this is the kind of conversation I think we need to have, and it did take you to organize it, so thank you, and I think it's very valuable. I also wanted to go to another question that came up. What will incentivize players to fund smaller ticket sizes of less than 200,000? And for that, actually, I'd like to call on someone, one of the participants in the audience. So Aceli Africa, so Safin, USAID supports Safin, and another program we support is Aceli Africa. And I saw Christabel from Aceli Africa online, and maybe you want to address that question. How do we incentivize lenders to fund smaller ticket sizes of less than $200,000? If you don't mind, Christabel.
Yeah, sure. Thanks, Songbe. Maybe I'll just take 2 minutes to just talk about that really briefly. So Aceli did a research study with about 31 different lenders a couple of years back, maybe 2 years ago, a mix of different types of lenders, so both international and national lenders and social lenders as well. And the idea was really to try and understand, looking at hardcore data, what is the challenge of lending to Agri-SMEs? And we found two things. One is that inherently agriculture is a riskier business to lend to. So if you look at the numbers, there's a higher risk associated with agriculture. And there's many reasons why, which I'm sure most people are familiar with. If you look at ag in Africa, it's essentially rain-fed agriculture, which comes with its own risks. If you look at certain issues that come with supply chain, logistic issues, there's a reason why I think agriculture has a higher risk, and we can go into that a little bit later. So that was one, that the inherent risk in ag is higher. Then the second thing that we found is that even if a loan is repaid, the return on that investment tends to be lower, and sometimes lenders don't actually break even. So even if they really wanted to lend to agribusinesses, it's not sound business because the ROI isn't quite there. Based off of those two challenges, one is the risk and the other one is thinking about the return on investment. So Aceli designed two incentive structures to really incentivize lenders to then on lend to agribusinesses. The first one is a past loss portfolio cover, which takes a lot of learnings, I think, from a lot of guarantee schemes that exist. And I think my colleague Andrew is on the line if you wanted to learn more about that. And then the second one is an origination incentive to incentivize lenders to then lend to agribusinesses that need a smaller ticket size. So understanding that the economics don't necessarily work, Aceli designed an origination incentive. Over time, we expect that as the business case starts to become clear, we do phase out that origination incentive. but they're going to need a bit of financial incentive to essentially take on that risk. And I think this brings up a question that we all keep sort of tossing back and forth, really, where there's an expectation that all of this risk in the agriculture sector should be taken by private sector. But I do think there are some things that really can only be covered by public funding. And so the question around blended finance that Mercy was raising, there's a role for public funding to incentivize private sector money. So with the SLE model, I think the way we're structured is to see how do we take that $1 that's in grant form and see how that unlocks more private capital. I think in our thesis, we hope that every dollar of grant funding essentially is leveraged 15x. Right now, we've through our lender network, we've reached about 100 loans that have been, lent to Agri-SMEs. Over 50% of them would never have accessed a loan before, and we're seeing about a 12x capital leverage. So just to summarize, I think two risks that make it difficult for lenders to work in that space: the risk and then the ROI. And we really need to think about the role of blended finance and how public funding can unlock private capital. Back to you, Songbe.
Thank you, Christabel. And I'm just conscious of time. I think we have about 10 minutes left, and I do want to leave a little time left at the end for Rachel and Bettina to close us out. So I'm just going to toss out 3 more questions that any of the panelists can answer, which ones they'd like. One is, when we talk about the answers to solve this gap, what would be the suggestions for different players? So we're just talking about, the investment funds here, but how about, SAFIN, how about AVPA, how about USAID? Any specific suggestions of what the role we should play? Also, the group that's not here are the SMEs, right? And what role should they play? What responsibility do they have, for this challenge? Another question I think that came up is, do we need more funds or more consolidation, in this space to help address this problem? And this is a perennial question for me. And lastly, technical assistance is something that's come up before. Are we talking about, do we need to have more funds to deploy more capital, more matchmaking, or do we need actually just to get more SMEs investment ready? So I throw those 3 out in the last 5 minutes for any of the panelists to answer any of them. Hans, or you're just the only one off mute, so
yeah, why not? Huh? And I'm not sure if I'm going to answer one of those questions of yours, but I think if I hear Mercy talking, then I think that's one of the things we've been trying to do, is to kind of reach out to this program at an earlier stage. So what we've seen, let's say, over and over again, is that there's a pipeline developed which really doesn't match for us. And so what we would really like to do is to actually, when you start developing those programs, then start working with the impact investors, like ASELI has been doing. So ASELI, which also has this, let's say, background with the CSAF members, there was a real need from the impact investors. There was hard data, and the program has been developed in collaboration with those investors. And what I often see is that there are programs developed which don't necessarily meet the needs of an impact investor, or are very specific. And so there are programs which are specifically for this type of company in this sector, in this region, with this product. And yeah, to kind of then have a match is makes it quite complicated. So I would say earlier engagement.
Thank you. And Deji, yes.
Yeah, I mean, if I would add to that, I would also say that there is definitely scope for more engagement between the funds. I think the role of players like AVPA is quite critical, but like Hans mentioned, I think it's important that groups like AVPA also work backwards to ensure that whatever is coming out of their pipeline is fit for purpose, right? Because if there is a pipeline you have and no impact investor is coming to look for them, there might be a mismatch somewhere. I don't know what that is, but it might just be a mismatch also. So the question is, how can we work backwards to get the input of the impact investors and whether it's commercial investors with impact focus, just to make sure that as we're building out these companies, as we're empowering them, giving them grants, the needs of the impact investors are actually also cater to. And then to the question of do we need more funds, I think we can have more communication, more conversations between the funds to be able to address the needs. The reality is that we can't just consolidate them because the niches are very different. Like we all said, all of us providing capital on this call are addressing different niches, ticket size, strategy, region, geography. There's opportunity to hand over one to another if there's more conversation, but consolidation just takes away that flexibility in being able to address to the different needs of different SMEs within the region.
Thank you, Deji. I just want to emphasize that point Hans brought up, and you continued the donors. First of all, we have lots of specific requirements, and obviously for an investor, you need you have an investment strategy, but then you need a lot of discretion to choose the best investments. And I think to your point also, Deji, is if it's the donors might be more focused on impact, but if they want it to be commercial, they need to think about the investors, perspective and whether there'll be demand for what the early donor funder is supporting. So I think that's just wanted to emphasize that. Edward or Mercy, is there anything else you'd like to add?
I personally believe that there is still a lot of room for co-investments and working together, even if it is for across investment capital and grant capital. Yeah.
Thank you. And I guess one thing is, Edward, Hans, and Deji, have you ever thought about approaching AECF before? Just kind of going back to Mercy's question. And to your point now, Edward, about combining, well, I guess you have worked with AECF, so much more.
Well, we've worked with our investees have benefited from AECF before. But I think hearing Mercy speak today, I'm sure I'm going to be very inquisitive to have a chat with her.
Yeah, Mercy, you said nobody was knocking on your door. I've knocked on your door yesterday, so you.
I've seen your email, and thank you. I'll respond to that.
All right.
And maybe Edward, if you really do investigate, you will find it's a coincidence that you invested in Western Seeds, and we happened to have granted them, that initial funding. I don't think it was a deliberate effort, and that's what I'm talking about. It has to be a bit more deliberate.
I think, Mercy, it was a deliberate effort because I discussed it on the board meeting at Western Seed.
Okay, yeah, that.
Yes.
And to Oiko's credit, we've been having discussions with Oiko, but more on the renewable energy side. And it's a question of the fit that Hans is talking about. We've been struggling to see a fit. And when I look back, it's what we're talking about. If the conversations had begun earlier at the program design level, not just ACF and the donor, but there should have been several investors on the table to co-design in this program to make it more relevant. And that's one of the key lessons probably for ACF and our donors. So Hans, we could pick up this conversation on the ag side, but at least we've been engaging with the team on the renewable energy side. And the one thing that has come out, it's a design thing. So then the investees just don't fit. So if we could correct for the design from the beginning, I think we could see better traction. Now, Songbe, on the issue of whether we need more funds or not, it's hard to answer that, but my thing is, having worked with these investees, the one thing that I see is missing is local currency funding. There's a lot of money, but in hard currency. So what can institutions like yourself and Safin do in terms of reducing the hedging risk, the hedging costs? Because we're actually working with a German institution to try and set up a local currency fund to address this problem, which I don't think is something AECF really should be doing. But having such a huge portfolio, it's a problem. It's become a real problem that we're trying to solve for. And one of the struggles that we're seeing is really, how do we get a cost-effective hedging partner that will make them the costs, bearable for investees, and we're struggling with that. And that's an area that you could step in terms of really making it more cost-effective to hedge these currencies, and let the investees.
Thank you.
Have
that was a
access
question that came
currency
in the chat box, and will be a completely, take up a whole other webinar. So I just want to say thank you to all the panels. A couple of things I'll just maybe highlight is that we discussed this path isn't linear, how it may not just be grants early on and commercial investments later, but how we can combine them and making sure also that the grants do not crowd out the commercial investors. We need more conversations, and this is a great start. And I also just think that there is not just new funds or new solutions dealing with FX, but just learning, what you do at a little deeper level. And then I think we need to have that understanding. It's hard to learn the stuff we just discussed on the website to kind of get to understand where each fund sits or each player sits along that continuum. I know we didn't get to all the questions. This is being recorded, and I think, Bettina, what I'd suggest is when we post it, we can also answer the questions that we didn't get to from the chat box. And with that, let me pass it back over to Bettina and Rachel.
Thank you, Songbae. Rachel, would you like to go first, maybe?
Sure. Thank you so much to the panelists. I really enjoyed the discussion. As Songbae said, I think some points were raised that each one could take hours of webinars to discuss. So as Bettina also mentioned, this is the beginning of many conversations that we want to have with this community. And so please follow up by email. Let us know what you want to hear more about. We would love to convene more of these discussions in depth. We'll also send out to everyone who registered some more information about the DealShare platform, which we are really hoping to promote more conversations like this and more cooperation between investors and grant makers and everything in between. So thank you, everyone, and look out for some emails from us.
Thank you. I just want to add, I would echo what Rachel just said. I was wondering whether we would have the kind of conversation that would reinforce our sense that we needed more. And I think, we've heard quite a lot of that. I just want to note something that Nuno Santos from FAO put in the chat, which is, do we actually have a clear sense of the landscape, both on the supply and on the demand side of finance for agri-SMEs at different stages of development in Africa? And I think that would be something worth exploring, because in order to have a conversation that is touching on the various key points, you need to have not everyone, because that's an impossible task, but you really need to have all the strategic players around the table. I really do hope that AECF has a fairly unlimited scaling up potential, since I can see that you're potentially in the market for a lot more demand for your services. But it's not just this. Obviously, there's again also other players in the ecosystem, and we look forward to continuing to play our role in facilitating these connections. Just let me say thank you, everyone, for being so open with sharing your experience, the work that you're doing, how you work with your investors, investees, etc. Thank you, Rachel, for this collaboration, and thank you, Songbae, for moderating. With this, I guess we just say have a great rest of the day, and thank you for being with us. Bye.
Thanks, everyone.
Thank you. Bye.
Thank you. Bye.
Thank you.
Thank you, everyone. Bye.
Bye.